David Hilder joins us now to discuss today's bank earnings and what we can expect when other big banks report next week. He's senior banking analyst at Drexel Hamilton. David, good to have you with us. Let's start with J.P. Morgan and Wells Fargo, the two banks out today. What did you make of their results, and are they buy, sells, or holds in your book?
Well, Tyler, thanks for having me on. I do have buy ratings on both Wells Fargo and J.P. Morgan. I think what we saw in the market today was a little bit of money flow out of J.P. Morgan and into Wells Fargo simply because Wells Fargo reported better than consensus estimates of earnings, and J.P. Morgan fell a little bit short. They're both very good banks. They're certainly making a lot of money. They're both in great capital positions. I think to some extent the first quarter is viewed as a bit of a symbol of what the run rate of earnings will be for the rest of the year. And so I think you'll see on Monday that some of the annual estimates for J.P. Morgan will come down as people think about more of a run rate for the rest of the year in the $1.30 to $1.40 range, not $1.40 to $1.50. Whereas at Wells Fargo, Wells reported $1.05, up from $1 in the fourth quarter, and I think estimates will be going up for the remainder of the year at Wells.
Can I jump ahead, David, to next week, because we have Citi reporting and also Bank of America. Both of these banks have legal and other issues for different reasons, and you're recommending both of these companies, both of these banks as well, and tell us why, and what are you expecting in their quarterly numbers?
My estimate for Citi is $1.15. That excludes the most recent mortgage settlement. My estimate for Bank of America is 25 cents. That's a little bit below the consensus. I'm being a little bit more conservative on Bank of America, again, because of some of the trading issues that we saw at J.P. Morgan. Again, I think over time, the big four banks, Citi, Bank of America, Wells Fargo, and J.P. Morgan are slowly but surely going to take market share from smaller banks as they have national scale, a diversity of businesses, and a diversity of risk. I think Citi at the moment is probably the most attractive stock in the group simply because it's trading at about a 20% discount to tangible book value. And I think Citi will, over the course of the year, be able to resolve the capital plan issues that the Fed had a few weeks ago, and Citi will be able to increase both its dividend and its share repurchase activity.
So fundamentally, you do not think Citi's problems are insurmountable. That was going to be my question, but you answered it. But let me turn it another way. Is banking the fun business it used to be, David?
Well, I think a lot of bankers would say that it was never all that much fun. I think today, look, I was at a conference this week with a number of players in a variety of financial businesses, and the one thing that they all said was that their relationships with their regulators are very tense, almost hostile. So I think it is very clear that post the financial crisis, the intensity of regulation, both in terms of laws and in terms of the attitudes of the regulators, has changed. Over time, I think both sides need to spend really more time talking to each other and figuring out how the banks can go forward and provide the credit and other services that the economy needs to grow faster.
All right, so banking is not as much fun as it never was. David Hilder, thank you very much. Senior bank analyst at Drexel Hamilton.